evening. This is the India Development Debate. I'm Taneia Bhardwaj and we are beaming to you live from our Mumbai studios. Now, the political attractiveness of an all-gain, no-pain budget is understandable, but days after Finance Minister Piyush Goyal presented his maiden budget, doubts are being raised over the credibility of his numbers. Many economists say that the budget calculations are based more on hope, prayer and windfall rather than credible revenue projections. The budget does not give a projection on RBI dividend, but many believe it could be around 80,000 crore rupees. All pointers to a situation wherein the RBI becomes the government's private bank for funding its welfare schemes. There's also a fear that with revenue collections tapering, the government will have to print currency to support the budget goodies, and this could stoke inflation. Piyush Goyal's budget map and what it means to the economy in the long run is what we're putting the spotlight on this evening on the India Development Debate. And to join in on that discussion, let me introduce our panelists for the evening. Our consulting editor, Maithili Pusnurmath, is here with us. We've got Mr. M. Govinda Rao. He's a member of the 14th Finance Commission and also former member of the PMEAC. We've got William Foster. He's a Vice President of Sovereign Risk Group at Moody's Investors Service, and Anant Narayan, Professor at the SP Jain Institute, also joins in. All of you, good evening and thank you so much for taking the time out. Maithili, let me begin by asking you, and let's talk about news that we have on our hands today, that we've already reached 112% of this fiscal's deficit target and the government's only met 60% of its revenue collections. There is this disquiet, you'll agree with me, about, the expansionary budget that we saw on Friday. The glide path, as Swami put it on this channel, seems to be only moving sideways. How worried should we be?
Well, we should be worried because the projections are very ambitious, but Taneia, funnily enough for the government, in fact the data that has been released just this evening shows the government's financial position better than it was at the time of the budget. Sure, we have reached 112 or 113% of the fiscal deficit, but at the time of the presentation of the budget, by which time we had numbers only till November, it had actually crossed 114%, and there has been a sharp increase in revenue receipts between November and December. So while I was very, very skeptical yesterday, today I am a little less skeptical. I am still skeptical, but less so than yesterday, because there does seem to be a tremendous increase between November and December, both in the tax receipts as well as in the non-debt capital receipts, that is essentially disinvestment. Of course, one can argue about the quality of the disinvestment, that has been from left hand to right hand with one PSU buying into another, but between November and December there has been an improvement, even though it is beyond the fiscal deficit target for the year. So I suspect that with a little bit of a nod and a wink, some little bit of smoke and mirrors, the government will achieve that figure that they have suggested of as against 3.3, 3.4, and remember we have the increase in the GDP numbers also. So possibly, in fact, even 3.3.
William, let me ask you, how realistic do you think the fiscal deficit targets laid out by the government are? Moody's has said that the continued slippage is going to be credit negative for the sovereign. The government has assured us that it's committed to reaching, the fiscal deficit target of 3% by FY21. Do you see us getting there?
So that's a very good question. The government did note that they intend to pursue the target of 3% in fiscal 21. So the fiscal consolidation, the glide path as they call it, didn't change. However, the annual path to get there did change. So we see that as ultimately that's going to be more challenging because going from 3.4 to 3% and from 20 to 21, it will be difficult ultimately, and it's difficult. Obviously, that's farther out in terms of the spectrum today. But ultimately, it's going to require greater progress on the revenue side through higher collections, as well as enhanced expenditure efficiency. And right now, it's going to really depend on implementation of the new programs that they announced, and ultimately growth. And the second part of your question had to do with growth. We do expect this year's budget to be supportive of growth. Ultimately, the income transfers and the tax cuts will support consumption, and so that should be supportive of growth. Our expectation is for growth this fiscal year of 7.2% and 7.4% for next year, and these would be supportive of that.
Mr. Rao, let me ask you, 3.4% might be reasonable, as you heard, William from Moody's say, but given the increased spending, whether it's the 75,000 crore to assure small farmers of an income, the 18,000 crore in tax sops for 3 crore middle class, it's going to be an uphill task, isn't it?
Well, there has been if you look at the numbers at their face value, there has been a pause. In fact, 2 years ago, we had 3.5%. We are talking about 3.4% this fiscal and the 3.4% next fiscal. Then the question of whether this 3.4% this fiscal, whether we can achieve it, considering the fact that your deficit has already exceeded 7 lakh crores, I don't really see much of a problem. The problem is not with the, because you see, towards the end of the year, there will be a lot more of pressure to collect more money. There will be a lot more of passing over of the bills to the next year. And they will somehow manage to sort of bring it down to somewhere about 3.4%. See, the problem with the entire set of numbers is the credibility. The credibility problem comes because we have a cash accounting system. In a cash accounting system, you can do a lot of jugglery and then say that I have achieved the thing. There will be so much of off-budget financing of expenditures as we go along. The same way, when you go to 3.4% next year, you have at the moment, it should only be taken as indicative because the regular budget will come only in July after the new government comes in place. But the basic issue there is, in this particular set of numbers that they have shown is that your GST is supposed to increase at 22% and personal income tax is supposed to increase at 17%. There is a 90,000 crores of disinvestment target, and there is a huge amount of money that they have budgeted for RBI dividends. Now, these are all, as I said, we have to take these numbers with a pinch of salt. And also, there is one other concern is that the capital expenditure next year is, supposed to grow only at about 6.2%.
Right. Mr. Rao, if I can just, Mr. Rao, sorry to interrupt, sir, but since you brought up the point of credibility, if I can just ask you perhaps a slightly controversial question. Just one day before the budget, we saw the GDP numbers being sort of bumped up. Do you believe that the bumping up of GDP numbers was, the sole purpose behind it was to shore up the fiscal deficit?
Well, it's not clear. There is in a cynical way of looking at it is that if you can't change the, numerator, you change the denominator. But that's not the point that I'm making here. If they say 7.5% in real terms, we need to talk about nominal terms, which may be about, 11.5%. And of course, the Economic Affairs Secretary has gone about saying that if you do that, we will get, our fiscal deficit numbers will come down. But, the basic issue is that there will be a lot of creative accounting, a lot of number game that is going to be played on.
Okay.
But as I said, my bigger concern is when you have our, if you see the public sector borrowing requirement is 7.5%. Your household sector financial saving is 7%. How are you going to have a low cost regime for your corporates?
Mr. Rao, we'll actually come to that, but let me just take it across to Anant as well. Anant, the government is betting on, higher corporate tax revenues and GST collections to shore up its fiscal. Is it being a bit too optimistic, you think?
I think, Taneia, the overall point is that the credibility of the numbers being presented is extremely low. I wish I could share Maithili's optimism. I can't. The numbers for this from the CGA website for December are available, like Maithili mentioned. Year on year, the revenue growth is just about 4%, right? Now, the budget says we will still mean, the revenue estimate, the revised estimate is still at budget estimate, which means between now and March, December and March, we would have grown so much as to have achieved 19% year-on-year growth. I just can't see that happening. I do see the final provisional numbers will be much lower in terms of revenue. Second, on disinvestment, we have a target of 80,000 crores. We're currently at 34,000 crores. I can't see that gap being filled up. I do see a gap coming up there. Third, what Mr. Rao said about, Dr. Rao said about off-balance sheet. It appears that expenses which ought to be paid to Food Corporation of India, for instance, are not being paid. Instead, Food Corporation of India is being encouraged to borrow from NSSF and other sources. 1.96 lakh crores, which is over 1% of GDP, is what Food Corporation of India has borrowed this year. And remember, like Dr. Rao said, because you follow cash accounting, if you don't pay the money, you don't recognize the expense. So between ambitious or overestimation of revenue receipts and these kind of fictitious and creative accounting, it looks like more than 1% of GDP is actually hidden in the numbers. And by the way, it's not just me saying this. Almost every alternate sell-side analyst is now saying this. It's become a joke to the extent that it's a pretense that everybody is aware there's a pretense involved. Unfortunately, the credibility of the numbers is very, very poor. And to add that, of course, the quality of the spend is also quite low. We are unfortunately not investing on irrigation, education, and productive purposes. We are largely borrowing to just pay our current bills, which includes your salaries and your interest rates and so on and so forth. So on multiple levels, and this is not a problem just of this government, it's a problem across all governments. We definitely need some sense of credibility to come around their entire budgeting process. At the moment, it's a joke.
Okay. William, what is your point of view? The assumptions being made in the budget, both on the revenue front, as well as tax, as well as, disinvestments.
Sure. On the revenue side, this year's budget there were no necessarily any positive changes that we'd expect to support increased revenue moving forward, unlike last year's budget, which focused very much on indirect taxes and a big increase in GST collection from 2.6% of GDP to 4%, which at the time we considered ambitious, and obviously that's playing out this year with a shortfall based on several changes, based on changes to GST rates as well as to the exemption limits. Next year, obviously, when you look at the continued challenges around GST implementation and the cuts that I just mentioned to rates and changes to exemptions, it's going to be more difficult to collect higher GSTs from this level because you're effectively thinning out the tax base on that front. In addition, you obviously have some tax cuts to the middle class in particular. So it's difficult to see any enhancements to revenues moving forward. But we'll look at more in the details ultimately to get a more clarity as to how realizable they are. They do look more achievable than they did, I would say, last year. But again, we'll come back to this later. On the expenditure side, obviously, there's more pressure from the new programs that were introduced for direct benefit transfers to farmers, as well as the announcement of some forbearance on interest rates, and ultimately no necessarily offsetting cuts in expenditure that would make up for that. So that puts pressure on the fisc more generally.
Right. Maithili, Piyush Goyal said in his budget speech that, had it not been for the farm package, the government would have easily achieved its fiscal deficit targets in FY19 and FY20. There's, of course, 75,000 crore being allocated for that, of which 20,000 crore, sort of is disbursed this year. But the budget estimates a deficit of something like 7 lakh crore in FY20. So then one would imagine that the slippage is also on account of other reasons, isn't it?
Taneia, I think I need to just make one small clarification.
Yeah.
Contrary to what Anand said, it's not that I'm optimistic. I'm still very skeptical of the numbers, but I'm less skeptical than I was when the budget was presented, for the simple reason that the single month of December, in revenue receipts alone, there's a 213,000 crore increase. So that's a very significant amount. So I'm still continue to be skeptical, but less skeptical than on Friday. Also, let us not forget that the government has various means, including what he alluded to as creative accounting, which all governments have done. So on paper, they will achieve that. There will be off-balance sheet, off-budget items. There will be rollover expenditure. So finally, what you will get is a beautiful number of 3.3, possibly because of the higher GDP number. But in practice, the quality of that fiscal deficit is suspect. But no more suspect, I think, than in the past. Over a period of time, because of large borrowings, the interest cost has been increasing. In fact, in just over 2 years, the interest cost has increased almost 25%. Now, that is a huge cause of worry, because if you look at the debt to GDP numbers also, there's been a marked deterioration. So yes, I continue to be skeptical, but less skeptical than when the budget was presented. As far as Mr. Piyush Goyal's claims are concerned, yes, he is largely correct that but for this higher expenditure, perhaps we would have achieved that deficit number, deficit target. But certainly, of course, that is not the only reason. There is the fact that we have a huge amount of, interest payments to make, a huge amount of repayments. So as against a 7.7 lakh crore gross borrowing, there is a repayment of almost 2.17 lakh crores, which is just repayments. So clearly over a period of time, our fiscal position is worsening, but because the economy has been growing quite well, we are still able to get through by the skin of our teeth.
Mr. Rao, the income support scheme, much like the UPA's Manrega, is here for a long haul. And in the coming years, one would imagine that unless and until the farmers' real income increases considerably, maybe we're going to see the allocation for it only sort of, move up. Having said that, and assuming that, what happens then as far as government spending on infrastructure and, other sectors go? Where do you reckon that money is going to come from, or are we going to see then a cut as far as capex goes?
Well, I haven't understood your question very well because I couldn't hear it properly. I guess your question is regarding the feasibility of this income support scheme. I think, any day, cash transfer is better than, giving input input subsidies, because cash transfers have less, they don't distort the relative prices, whereas input subsidies do. But then, again, 6,000 rupees per farmer, with less than 2 hectares of land is not a very large sum, and 75,000 crores is not a very large sum in that sense of the term. But the concern is whether, since you are not able to cut down on other subsidies, basically food, fertilizer subsidy and transfers, Narega, this is an additionality, and that additionality is going to hurt much more. And there is no plan to cut down other subsidies as well, and that's one of the major concerns one has, because as was pointed out by Anand, it was 1.9 lakh crore of Passover bill, sort of borrowing by the Food Corporation of India. Something like 40,000 crore from fertilizer, for the fertilizer companies, things are being passed over. So there is much more serious than, sort of just talking about 0.2, 0.3%. This 75,000 crores in that sense of the term is not a large sum, but there are bigger holes in the system, and that is what creates a lot more trouble. As far as the things that have happened over time, let me tell you, the report of the Controller and Auditor General presented a month ago to the Parliament basically tells you the time series of how the passing over of the subsidy bill has happened over a period of time. It was hardly 20,000 crores. Now it has reached somewhere about 60, 70,000 crores. Now I think, all governments are guilty, but some are more guilty than the others. That's all I can say.
Anand, let's talk about the divestment target. Again, you alluded to that earlier. For FY20, it's been set at a tall 90,000 crore, 12.5% more than the 80,000. There's already a question mark on the ability to meet the target for this year. How achievable is 90,000 crore going to be? And as Maithili said, are we just going to see a lot of left hand to right hand?
The classical answer to questions like this is it depends, Tanya. Who knows what markets will be like next year, and we'll have to see that.
Yeah.
In good conditions, 90,000 crores has been achieved. If you remember, last year we achieved over 1 lakh crores. So it is possible in the right market conditions. But yes, this right pocket, left pocket, unfortunately, has become a feature of all our divestment plans. Just one couple of quick points. Maithili mentioned that December numbers are looking better in terms of revenues. That's largely because you have advance tax coming through in December, and you do see a seasonal bump up in every December on the revenue collections. The way to look at this actually is to compare year on year how we are right now compared to the same period last year. As of November end, we were up about 4.4% in revenue terms. As of December end, with this bump up that Maithili mentioned, we are up less than 4% year on year. And this is lower than our nominal rate of growth. And a budgeted number for the full year is 19% growth. If you have achieved 4% for 9 months and expect to achieve 19% for the full year, something doesn't add up somewhere unless somebody has got a treasure trove which has not been discovered as yet. So, clearly, as far as revenues are concerned, there seems to be overestimation or too much of positivity. Likewise, on divestment, like you rightly mentioned, and like Dr. Rao was mentioning, on the accounting as well, on the accounting smokescreen that has been built up, the numbers are quite large. Now, it's an election year. Every government is given a long rope during election year, but these numbers do look egregious. At the moment, it looks like over 1% of GDP is the nature of the accounting smokescreens. Again, going into probably the wrong kind of spending rather than investments.
Yeah, my last question to you, the government's expansionary stance, both in FY19 and FY20, as many on the panel said, could also drive up inflation and interest rates that could end up hurting growth. Do you think that could compel the RBI to maybe stay put on rates for a bit?
Well, yes, that is my sense, because clearly the budget is quite expansionary. And remember, we have core inflation at close to 6%. Corporates are already saying that they are near full capacity. So certainly there is going to be an inflationary pressure. So my sense is the RBI prudence demands that maybe they could change their stance and change from, make it more neutral rather than tight. But as far as interest rates are concerned, I think the best thing would be to wait, hold your horses for the now, see how the fiscal plan pans out, because remember, we don't know what kind of government is going to come, what kind of budget we're going to get in July. So there's no urgency, and luckily for us, the Fed has gone much slower on its interest rate hikes. So the RBI can afford to wait. At the moment, I think that would make more sense, but let's see what the new Governor Shaktikant Das has for us on Thursday.
With that, Maithili, Mr. Rao, Anant Narayan and William, thank you so much for taking the time out for this discussion. We'll take a quick break and be right back.